there are plenty of other big name stocks that have been left behind. I mean, take Uber. I mean, honestly, take Uber. This thing's down 15% for the year. Yet this morning, CEO Darius Khosrowshahi told us on Squawk Box, not on Squawk on the Street, just in case you're wondering, Squawk Box, that business is much better than expected for both ride-sharing and delivery. Those are the twins, okay? The only problem is that there aren't enough drivers. But he gave us some evidence, strong evidence, that the driver shortage will go away once the expanded unemployment benefits expire at the end of the summer. He gave us a bunch of cities where the benefits had already gone down, and those don't have shortage of drivers. Granted, Uber's not cheap on any traditional valuation metrics, but it's certainly undervalued versus where it's been trading and its peers. Okay, now let's just talk about stocks that are being given away. Let's talk about the chemical stocks. Now, these trade like we're headed for a truly nasty recession. We recently had LyondellBasell on the show. They're a diverse maker of all sorts of plastics. Really boring, but that's all right. Boring's okay. It's a chemical company, right? And this thing sells for 5 times this year's earnings, and it's got a 4.7% yield. 5 times 4. That's insane. Considering its prodigious cash flow and excellent management, it's hard to come up with any justification for why Lyondell should be this cheap. But money managers just say, forget it, Jim, it's peak earnings, which must be like, forget it, Jake, it's Chinatown. How about Trinzio? I know, the name itself says sell, right? But how about Trinzio? It's a plastics company we've praised in the past. Trades at less than 5 times earnings. I don't know. Forget it, Jake. It's the same story with the steelmakers. Barring a worldwide calamity, not peak, but actually maybe an apocalypse, some of these valuations are absurdly low. Cleveland-Cliffs and Nucor sell at 4 and 5 times earnings. While Cleveland-Cliffs is a cobbled-together company with a not-so-good balance sheet, Nucor is the best-run steelmaker on earth, one that's making fortunes right now with a terrific balance sheet and a healthy dividend. Yes, peak, it won't go up, but I don't think we're at peak. You might shy away from owning something like Robinhood, but the steels, even if the Delta variant crushes the global economy and cuts their earnings in half, the stocks would still be ridiculously cheap. It's the same deal with the home builders. I mean, Toll, Doug Yearley, he's a really good manager. Lennar, Stuart Miller, executive chairman, D.R. Horton, they're all clustered around 9 times earnings, except for KB Homes, which sells for less than 7 times earnings. These stocks are all pricing in a future with much higher mortgage rates and no customers, yet they don't reflect the relentless demand for new homes created by both COVID and plain old population growth. That's like people having children. If Fed Chief Jay Powell stays true to his word and lets the economy percolate rather than raising interest rates, these stocks can roar. Or let me put it another way. We're currently building 1.6 million new homes right now in this country, okay? We have demand for 2 million homes. 2 million. Finally, they're the automakers. These are hard. Stung by the chip shortage and rising raw costs, GM and Ford now traded at around 8 times earnings. I know that may be wildly overvalued if we're going to a recession or if it's peak Chinatown, but I don't think we're going into a recession. And it seems nuts to think that the Fed will create one right as we get another huge COVID outbreak. Forget it, Jim. No, I won't forget it. When it comes to the autos, pretty much every car they get on the lot sells, and sells at full price. There's no discounting out there. No. So look at it this way. 7 years ago, Ford traded at $18, okay? I know, I was at Dearborn. I was there when they were making the trucks. $18. Now Ford's at $13.71, okay? $18. Do you really think that no value was created in the last 7 years? Do you think that this company should be worth less now than it has a full line of electric vehicles on the way, a rapidly improving balance sheet, and a commitment to stop building cars in countries where it has a long history of losing money? When I think of the new Ford, I don't think of losses. I think of sold out, as in everything they make seems to be sold out. And Jim Farley is really changing that company. Bottom line, I know this take seems contrarian in a world where how long can this craziness last? But my most frequently asked question after can I get some Jim's None Better pickles? The answer, forget the craziness. Focus on the cheap stocks that have done nothing and sell for peanuts. They're a lot more plentiful than you might think, even more plentiful than a bushel and a peck of Jim's None Better sour dills.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.